All right, y'all, so chapter 8 is all about internal control and cash. So how do we handle the cash in the business, and how do we put controls in place to handle that cash that we have in the business to make sure that everything is on the up and up and everything is where it's supposed to be and nobody's, skimming from the top. So our learning objectives for chapter 8 are that we are going to define internal control and describe the components of internal control and control procedures. We're going to apply internal controls to cash receipts. We're going to apply internal controls to cash payments. We're going to explain and journalize petty cash transactions, explain and journalize credit card sales, demonstrate the use of a bank account as a control device, and prepare a bank reconciliation and related journal entries. And lastly, we are going to use the cash ratio to evaluate a business's performance. So our first learning objective here is that we are going to define internal control and describe the components of internal control and control procedure. So when we talk about internal control, what we're really talking about is the plan that an organization has that will safeguard the assets, encourage employees to follow policies, have something in place so that if we notice an employee not following a policy, we have a safe way to bring that to the attention of the stakeholders. We're going to promote operational efficiency and ensure that accurate and reliable accounting records are being kept. So that is really the basis for internal control. It's really just how do we make sure that things are being done in the way that they are supposed to be done to make sure that everything works the way that it's supposed to. So when we talk about an internal control plan, we want it to be able to safeguard the assets, encourage those employees to follow company policy, promote operational efficiency, and ensure accurate and reliable accounting records. And that is really what goes into that plan. So typically the internal control plan is actually a written out plan. Obviously, you will most likely find a lot of it in like an employee handbook and that type of thing, as well as just documents that say like this is how we're going to do things, the policies of the company and how they want employees to do certain tasks. Internal control and Sarbanes-Oxley. So Sarbanes-Oxley was a really, really important case that came through the court systems, and so the Sarbanes-Oxley Act is out there, and so we're going to talk about that a little bit. So from Sarbanes-Oxley, we have the Committee of Sponsoring Organizations, so the COSO, and this provides thought leadership related to enterprise risk management, internal control, and fraud deterrence. So that's a lot of words there. So it really provides guidelines on how risk management should happen. So how do we mitigate risks? How do we limit the amount of risks that a company takes? That internal control piece, and then fraud deterrence. How do we make sure that fraud is not happening? The COSO's mission is to develop the frameworks and guidance to help companies improve their internal controls and reduce fraud within those organizations. Public companies are required to do this. So companies that sell stock to the general public are required by the U.S. Congress to maintain a system of internal controls and to have that system in place for pretty much everything they do to make sure it's all happening the right way. So the Sarbanes-Oxley Act. So this was an act that was passed by Congress. We call it SOX for short. And it is to address the public concern about various accounting scandals. So this really came out from the early 2000s when we had the whole Enron situation along with several other companies. So it requires companies to review internal controls and take responsibility for the accuracy and completeness of their financial reports. So basically what it says is it says that the companies have to say, yep, that is accurate, and we're going to take responsibility for that. So if it's not accurate, it's going to come back on the company. It also dictates that they have to review their internal controls, which means that typically once a year, they have to look at their internal controls and they have to determine whether or not they are working. And if they are not working, they have to determine how they're going to move forward from there and develop internal controls that will work. So the SOX provisions, a public company must issue an internal control report. This is a report by the management that describes its responsibility for the adequacy of internal controls over financial reporting. Basically, this means that an auditor is going to come in and they're going to take a look at the internal controls and determine whether or not that is accurate. And that auditor should be from outside of the company. So it should be somebody coming from a different organization into your organization and taking a look at what's going on. And two, the Public Company Accounting Oversight Board, the PCAOB, oversees the work of auditors of public companies. So it just means that there is a board that is going to look at those auditors and make sure that they are doing what they need to be doing. Number three, accounting firms are not allowed to audit a public company and also provide certain consulting services for the same client. This one just makes sense. However, it seems like it's common sense, right? That the accounting firm that essentially prepares the financial statements should not also audit the company that they're preparing the financial statements for. But it has to be said because obviously it happened in the past. So it just means that if you have somebody coming in to audit or to look over your books, that person needs to be different than the person who deals with that information on a daily basis. It also, number four, the fourth provision here, it gives stiff penalties for violators. So if your company is found to be violating one of these provisions, it's 25 years in prison for securities fraud and 20 years for an executive making false sworn statements. Basically, if you lie or you screw something up royally, you are going to prison for a very long time. So don't do it. So the components of internal control, they use the acronym CRIME. So control procedures, risk assessment, information systems, monitoring of controls, and then the environment. So the internal controls are monitored by internal auditors and external auditors. So typically what will happen within a company is they will have their internal auditors who are responsible for going throughout the different departments of the business and looking everything over. And then they also have external auditors who come from an outside company and they come in to look over everything that's being done as well. So those internal auditors should be responsible for finding issues before they become big issues, before those external auditors come. But the external auditors come in just to also make sure that everything is on the up and up. So internal control procedures. So the things that many businesses go through for their internal controls. These are things that most companies will have in place. They have competent, reliable, and ethical personnel. Basically what this means is that they're going to hire individuals that can actually do the jobs that they are tasked with doing and that they can do them in an ethical way. So when we define ethical way, we mean they're doing it the right way. When we talk about ethics, it's really the basis of right versus wrong that is socially acceptable. So ethics is kind of that broad range. When we determine that something is ethical, we're saying that it is right overall. Okay, there is a difference between ethics and morals, but we'll get into that at another time. They have assignments of responsibilities. This just means that we are going to assign certain employees with certain tasks, and then they're not supposed to do those other tasks. And what plays into this is the separation of duties. This is a division of responsibilities between two or more people to limit fraud and promote the accuracy of accounting records. So oftentimes what we'll see is that the different departments, even within like the accounting department of a company, they assign different tasks to different people. So like you'll have one person in charge of accounts payable and you'll have one person in charge of accounts receivable, and they don't typically do the other person's job. And the reason why we do this is because of that separation of duties. When we have multiple people doing these different tasks instead of one person doing everything, we automatically just move into a safer space, because the likelihood that multiple people are going to do the wrong thing and try to steal or commit fraud, that kind of thing, is a lot lower than one person doing that. Other internal control procedures. We have audits. So internal audits are performed by employees of the company. External audits are performed by independent auditors, so they're not employees of the company. It is a separate business that the company will contract out to and say, hey, we need for you to come in and take a look at this. And those auditors, really, the job of an auditor is really just to come in and take a look at everything that's happening and determine if it's being done the correct way. Okay. There's also documents that come into internal control procedures, different things that have to be signed by different people, forms that have to be filled out, that type of thing. There's also internal control for electronic devices. For example, sensors attached to inventory can reduce theft. So, like you go into Target or Walmart and you go to buy like an electronic device or something, and it's got that security tag on it, that is a form of internal control. That is reducing theft within the business. So a lot of the internal controls that I've talked about so far have dealt with just employees, but this can also take place within inventory to reduce theft by having those different sensors attached. There's also internal controls that come up with electronic devices for employees, such as monitoring employee computer usage, that type of thing. And we see that a lot in the business world. It just kind of happens. Other internal control procedures, so e-commerce. There's encryption that happens when you go to buy something online. It uses a mathematical process to encrypt the information that's going out there, and that's just to make sure that, if I buy something from Amazon, an employee at Amazon can't necessarily see my credit card information. They just see that, okay, yep, Courtney paid for it, we're good to go. And then firewalls, which can limit access to local networks. So we can say, like, because there's a firewall in place, like, I can't access that website, or I can't access those files. Passwords, PINs, signatures for additional security measures. We're all familiar with passwords. Passwords are a form of internal control. It means that, my accounts are password protected, so nobody else can access them. We have passwords here at the school. Like, I have a password to log into my laptop. I'm the only one who has that password with my employee ID number, and that's how I access my laptop. That's how I access my gradebook. That's how I access a whole lot of things. And that is a control procedure to make sure it's not just all out there in the world. Other controls that are there are fireproof vaults, alarms, loss prevention specialists, fidelity bonds, and mandatory vacations and job rotation. So I want to touch on the mandatory vacations and the job rotation a little bit. So oftentimes we will see in larger corporations there are mandatory vacations. So for example, I used to work at a bank, and I had to take a week's vacation every single year. I was required to take a week's vacation every single year. I got 2 weeks of vacation, and one of those weeks I had to take for at least a 5-day stretch. So I had to take an entire week at one time. And the reason why they did this is because I'm working at the bank, right? And I have control over money all day, every day. The idea is that if I had to take a week's vacation, then somebody else would have to fill in and do some of my job roles during the time. So if I was doing anything that would be considered unethical or illegal, it should be found out during that time. And we see mandatory vacations in several different job areas as well. So my example is just at a bank, but there are several other areas that require that. And then job rotations. And so job rotations means that they will rotate the job that you're doing at a company periodically to make sure that somebody else gets to step in there. So if something is happening, it's found out, and they can make changes if needed. Limitations of internal control, so costs and benefits. So obviously there are always limitations to everything we do. So internal controls cannot completely prevent fraud, especially from employees. So sometimes fraud just happens. Sometimes it just happens. And we can't control every single situation. Collusion occurs when 2 or more people work together to circumvent the internal controls and defraud a company. So if y'all have ever seen the movie Mad Money with Queen Latifah, that is a really great example of fraud within a company and collusion that happens between multiple people working together. So basically what happens is, let's say I'm working somewhere and my buddy's like, hey, let's steal some stuff. And I'm like, yeah, let's do it, right? Now we are colluding together. We are working together to defraud that company. And typically what happens is that with the stricter internal controls, the higher the costs will be. So when a company is deciding on their internal controls, they really have to look at the cost versus benefit. So if it's a smaller company, they're probably not going to have as many internal controls, but the larger companies are going to have more, simply because they can afford to have more, or simply because the business that they're doing requires them to have more, they'll do that. But companies do have to make those decisions for themselves as to what they're going to spend their money on. Do they want a lot of internal controls and spend the money on it? or are they just going to make do with a few internal controls and hope for the best? Learning objective 2, we're going to apply internal controls to cash receipts. So what are the internal control procedures with respect to cash receipts? Cash receipts occur primarily when a business sells merchandise to services. So when we sell something, we generate a cash receipt, and we have certain internal controls that control what happens with that. So each source of cash has a unique security measure. So whether it's actual like physical cash, or if it's a credit card or that type of thing, we have different security measures that are there. So receipt of cash over the counter in a store involves a point of sale terminal, so just a cash register. That is one of the control procedures that we can have in place. We just have a cash register. Many companies receive checks by mail in payment for services or merchandises. Several controls are needed for cash receipts by mail. So if we're taking checks by mail, there are several other things that have to be done there. So oftentimes, the check may need to be photocopied, it may have to be scanned in, the check number may need to be recorded. There are several different control procedures that may take place in that case to ensure that that gets recorded with the customer and credited to their account. So cash receipts by mail. So oftentimes we'll get checks. So when those checks come, so somebody goes to the mail room, they grab the checks, it goes to the treasurer, they generate a deposit ticket, it goes to the bank. From the bank, the controller for the company is going to look at the bank statement to see that that was there. So the remittance is advice is basically it's just like, hey, we got this check. That goes to the accounting department, and total amount posted to cash is recorded there, and then the controller looks at all of that. So you'll see here that when that check comes in the mail, there's two different ways that happens. There's two different kind of areas that has to flow through. So it's not just one person looking at it, we have multiple people looking at it. And you'll notice that a lot with internal controls is that the more people we have looking at something, the more control there is over it in that case. So cash receipts by mail. So this is just a deeper explanation of that graphic that we just looked at. So step 1, all incoming mail is opened by a mailroom employee. The mailroom employee sends the customer checks to the treasurer, and all remittance advices to the accounting department. The remittance advice is an optional attachment to the check. It basically just says how much the check is for, who it's coming from, it has the check number on it, all of that fun stuff. A lot of times those are sent by businesses with the actual check. Step 2, the treasurer has the cashier deposit the check in the bank, and the cashier receives a deposit. Step 3, the accounting department uses the remittance advice to record the journal entries to cash and the customer accounts. And step 4, as a final control, the controller compares the following records for the day: the bank deposit and the debit to cash from the accounting department. So it flows through two separate departments, and then it all comes to that controller to make sure that it was done in the appropriate way and that everything happened the way it needed to. So, for example, if the accounting department sends something over, but the treasurer didn't do their part, then that controller can say, hey, wait a minute, where's this check? Why hasn't it been deposited yet? A lockbox system could also be used. This is a system in which a customer sends their checks to a post office box that belongs to the bank, and a bank employee empties the box daily and records the deposits into the company's bank account. It just kind of skips like that middleman. So the company doesn't send the check to somebody else, they just send it directly to the bank. And I will say that if a post office box is used, then typically what happens is that 2 bank employees would have to go and empty that and take that back to the bank. So it's not just one person ever alone with that check. Learning objective 3, we're going to apply internal controls to cash payments. So what are the internal control procedures with respect to the cash payments? So companies make the payments by check. Payments by check provide internal control. So the check provides a record of the payment. The check also requires the signature of an authorized official, so it doesn't necessarily have to be the account holder, but it is somebody who is authorized to actually sign the check. So we call them a check signer. And then supporting evidence is reviewed prior to the check being signed. So that person who's authorized to sign the check, they're going to look at, okay, why are we writing this check? Is the amount correct? All of that fun stuff. So when we're making that payment, there's a lot of different controls that can be utilized. So we have the purchase order. So purchase something, then the inventory comes in, then we get the invoice, then we send the check, okay? So, and that check goes to the manufacturer, and there's a whole lot of stuff that goes in between there. It's very graphic. So controls over payment by check. So the controller or the treasurer should examine the payment packet to prove, 1, it received the goods that they ordered, 2, it's paying only for the goods that were received and authorized, and 3, that it's paying the correct amount. So before that check even gets written, there's several other things that happen. So the goods are received. Then we have to check to make sure that the goods that we received are actually what we ordered, and then we're going to make sure that the amount that we're paying is the correct amount. So to streamline those procedures, there's a couple of different ways that we do that. So there's the evaluated receipt settlement, the ERS. This is a procedure that compresses the payment approval process into a single step by comparing the receiving report to the purchase order. So all of these are electronic systems that a lot of companies will pay for. Or there's the electronic data exchange, the EDI, and this is a streamlined process that bypasses the paper documents altogether. Computers of customers' communicate directly to the computers of the supplier to automate routine business transactions. And we see this a lot for businesses that are buying frequently. They'll use that system as opposed to going through all the rigmarole of actually writing and sending the check. These systems are typically only used by larger corporations. You won't see these necessarily in your small businesses, and that's okay. Learning objective 4, we are going to explain and journalize petty cash transactions. So the first thing that we need to look at is essentially the definition of petty cash. So petty cash is usually a small amount of cash that is kept in an office for small immediate purchases. So petty cash can be used for like, oh, I'm going to treat the staff to donuts today, or oh, hey, we ran out of toilet paper, I need to go buy some real quick before our order comes, or you know what, somebody passed away, so we're going to send them some flowers. So petty cash is just that small amount of money that you kind of keep on hand for like almost like emergencies or that type of thing. And oftentimes the responsibility for petty cash is designated to one employee. And that employee will give the cash to the person who needs to go buy whatever it is, and then that person brings back any change and the receipt. Okay, petty cash ticket serves as an authorization for the payment. So that one person who's in charge of it kind of gets to say, yes, we can do that, no, we can't do that with petty cash, that type of thing. And you'll see here some examples for the uses of petty cash, and I already said some of these. So, office donuts, cleaning supplies, sympathy flowers, entertaining clients, public transportation, tips for service providers, that type of thing. So it's really just for those like incidental purchases that aren't necessarily like a normal everyday thing. So when we set up the petty cash fund, this is the journal entry that we will use. So on August 1st, Smart Touch Learning creates a petty cash fund of $200, and the custodian cashes the $200 check and places the currency in the fund box. So on August 1st, we have a debit to petty cash for $200 and a credit to cash for $200. Petty cash is an asset account. So when we set up the petty cash fund, for each petty cash payment, the custodian prepares a petty cash ticket. And so then these tickets are used at the end of the month to make sure that everything balances. So in an impressed system, an impressed system is a way to account for petty cash by maintaining a constant balance in the petty cash account. At any time, cash plus petty cash tickets must total the amount allocated to the petty cash fund. So we opened the account with $200, and so we should always either have tickets for in petty cash or cash in the petty cash fund that totaled $200. So in this case, on August 25th, $60 was used for letterhead. So it'll come out of office supplies. So on August 31st, the petty cash fund holds $118 in cash and $80 in petty cash tickets. You can see that $2 is missing. So on August 31st, they did a balancing of the petty cash fund, and they found that they were short $2. This does happen quite frequently with petty cash, and so we're going to find out what to do about this. So We are going to replenish the petty cash fund because we do want it to have that $200 in there. So we're going to write a check payable to petty cash for $82 to bring the cash back on hand back up to $200. So we debit office supplies for $60, we debit delivery expense for $20, and then we also have to debit a new account called cash short or over for $2 because we were under in our petty cash, we were short for $2, and then we credit cash for $82. When cash is missing from the petty cash fund, the cash short or over account is used to record the unaccounted for amount. We're not necessarily always going to be like super upset in this case over $2. Like if we can find the $2, great, but we're not going to spend like an entire day looking for $2. The petty cash account is used in a journal entry only when the fund is started or when it is increased or decreased. When replenishing the fund, the company debits the other associated expense accounts and then or the asset that is purchased with the fund. So we don't ever use petty cash unless we are increasing or decreasing the fund once it has been established. At times, the sum of the cash in the petty cash fund plus the tickets may exceed the fund balance. Consider the previous example. Assume that the petty cash ticket 102 for delivery was $30 instead of $20. So we had $200 in there, cash on hand is $118, and petty cash ticket totaled $90. Now we are over by $8. So let's look to see what we have to do about that $8. So in this case, the cash on hand plus the cash tickets was $208. That's more than what should be in the fund balance of $200. A cash overage exists. So the journal entry to replenish our petty cash fund looks like this. Again, we are going to debit office supplies for $60 and debit delivery expense for $30 in this case. And then we are going to credit cash over short for $8 and credit cash for $82. This will bring our petty cash fund back up to $200 and it gets rid of that $8 overage that we had. On September 1st, Smart Touch Learning decides to increase the amount in the petty cash fund from $200 to $300. They just realized, maybe the $200 wasn't quite enough, so they're going to put an additional $100 in there. In order to do this, they have to write a check out to petty cash for the additional $100, cash that check, and then place it into the petty cash box. So we see here that because they are increasing their petty cash, they're going to debit it by $100 and then credit their cash account for $100. So learning objective 5, we are going to explain and journalize credit card sales. So there's a couple of different methods to utilize when we are recording credit card sales. So we're going to look at the net method here. So Smart Touch Learning sells merchandise inventory, ignoring cost of goods sold in this case. Okay, we will not usually ignore cost of goods sold, but in this case we're going to ignore it just for the sake of this example. To a customer for $3,000 on August 15th. The customer pays with a third-party credit card. The card processor assesses a 4% fee and deposits the net amount. So the entry for this sale is as follows. Here's the thing to pay attention to. Anytime a company allows you to utilize a credit card, they have to pay a processing fee for that. So in this case, that processing fee is 4%. So think about it. Every time you go into a business and you use a credit card or a debit card even, that company is getting charged a fee for that. So sometimes what we see is we'll see that businesses will then pass that fee on to their customers. For example, I just got my hair done last weekend, and a new thing that my salon is doing is they're saying, look, to help combat some of these costs, we're actually going to push this credit card processing fee onto our customers. So when I got my hair done, I actually had to pay a 3% fee in order to utilize my debit card to pay for the services that I had received that day. Had I known that ahead of time, I probably just would have gone to my financial institution and taken cash out so that I wouldn't have had to pay that fee. The journal entry looks like this. On August 15th, we're going to debit cash for $2,880. We're increasing our cash for that sale that we made. Remember, it was a $3,000 sale. And then we're also going to debit credit card expense. So this is that 4% fee. So 4% of $3,000 is $120. So we debit credit card expense for $120. And then we're going to credit our sales revenue for the entire $3,000. So it's the net of the fee. So we're recording the net amount here in terms of the cash. So the gross method looks like this. So we're using the gross method. So it just is a straight a straight deposit for the $3,000. So cash is debited for $3,000, and then sales revenue is credited for $3,000. At the end of the month, using that gross method, the processor will collect the 4% fee. So instead of doing it right away, they're going to do it at the end of the month so that it all comes out in one go. So we still have our debit for credit card expense for $120 and a credit to cash for $120. So it all works out to be the same, but it just is when that processor decides to take that fee. So learning objective 6, we're going to demonstrate the use of a bank account as a control device and prepare a bank reconciliation and related journal entries. So common bank controls, bank account controls. So different things that a bank can be utilized to control what's happening within your company. So there is what's called a signature card, and this is a card that shows each of the authorized person's signatures for the bank account. So these would be our signers. So our check signers. So who can sign for the account? Who can go and get bank statements, that type of thing. So you have to sign what's called a signature card, and that just states the person's name who's allowed to go there and conduct business with the bank, and then it also has their signature. And then a deposit ticket. So the deposit ticket is a bank form that is completed by the customer and shows the amount of each deposit. And this becomes really important, especially if a customer is simply dropping their deposit off and they're not waiting at the financial institution for that deposit to be completed. Oftentimes we see businesses will utilize what's called a night drop, which means that they will drop off their deposits at the end of each day with a deposit ticket, and they will do that after the bank has closed. So it's really important for our businesses that are open, say, after banking hours, because most financial institutions these days close between 5 and 6 p.m., but we have a lot of businesses that are open much later than that. Other common bank controls would be a check. Simply utilizing a check is a control because we're able to track that a lot better than we are just regular cash. So the maker is the party who issues the check, so the person who's sending the check to somebody. The payee is the individual who is being paid by the check, so it's the person receiving the check. A routing number identifies the bank upon which the payment is drawn. So what that means is that routing number is specific to the financial institution that check is coming from. And then the account number identifies the account within the financial institution where the payment should be taken from. So this is an example of a check with a remittance advice. So this is just showing the details of the check, and then it shows the check itself. Y'all should be pretty familiar with what a check looks like, so I'm not really going to go through this. I do just want to take a second to point out that where the check number is, because that is a different one. So the check number that we may not be as familiar with dealing with. So the check number is right there. I just circled it in red. Probably should have highlighted it for y'all. There's a lot of red on this slide, but that is the check number, and that is going to be vitally important as we move forward through all of this, because we use the check number to identify those checks quite a bit within a business setting. Then we also have a bank statement. This bank statement reports the activity in a customer's account. Y'all can typically see bank statements online. Everybody gets a bank statement whether you realize it or not. So even those of you who have checking and savings accounts at a financial institution, y'all get a bank statement. You just may choose not to look at it. So it's going to show the beginning and ending balances for that bank statement, and it's going to list all of the ins and outs that happened. So how much money came in, how much money went out, and it shows the individual amounts. So if you're a person who uses your debit card quite a bit, if you go and you look at your bank statement, you're going to see all of those individual purchases that are there. And then we also have canceled checks. These are physical or scanned copies of the maker's cashed and paid checks. Typically, canceled checks, okay, so back in the day, I'm going to date myself here, back in the day, my mom used to get an envelope full of canceled checks. So these would be checks that she would write out to pay bills, that type of thing. So these are the checks that she wrote out that then got cashed at other banks that were then sent back to her bank that were then sent back to her, okay? This doesn't really happen anymore, okay? Nobody actually sends the physical checks in the mail. Typically, you can go online and you can view a copy of the check that has been scanned. So we don't really see the physical checks coming back to the person anymore. So this is an example of a bank statement. It's pretty basic here. So it shows the beginning balance here, total deposits, total withdrawals, service charges, and then it shows our ending balance. And you'll see here it details out every one of the deposits, all of the checks that we wrote, other deductions, that type of thing. So we see all of that here. So in electronic funds transfer, this is an important one. So it's called an EFT, electronic funds transfer. This is a system that transfers cash by electronic communication rather than by paper documents. Y'all think PayPal, Venmo, Cash App, what are the other ones out there? There's so many of them these days. So we actually have a lot of places that utilize electronic funds transfers, and it's becoming more and more common these days to utilize that type of thing. This can also happen just between financial institutions. So like I can send money to, one of my sisters through my financial institution and never have to use, an outside app or that type of thing. So it's just sending money through an electronic system where we don't actually have to use paper documents. So the bank reconciliation. The bank reconciliation is a document that a company uses to compare the differences between cash on the company's books and in their bank records. So basically what this does is it takes that bank statement and it compares it to the records that we have as a company, and it looks to see if there are any differences and to make sure that everything is reported accurately and all of that fun stuff. So on the bank side of the reconciliation, it'll show deposits in transit. These are recorded by the company, but not yet in the bank. It will also show outstanding checks, the checks that we've written but have not yet been cashed. It'll also, you will also see any bank errors that have either incorrectly increased or decreased the bank balance. On the book side of the reconciliation, we'll see credit memorandums or credit memos in which the cash receipts the bank has received and recorded, but the company has not recorded on their books. We'll see EFTs, electronic fund transfers. We'll see service charges, often referred to as debit memorandums. Nobody uses these words anymore. They just call them service charges. And then we see interest revenue on the checking account, and then my all-time favorite, the NSF check, the non-sufficient funds, which are received from customers for payment of services rendered or merchandise sold that really turned out to be worthless because the person who wrote that check didn't have enough money in their bank to actually pay it. So those are super sad, but always fun to deal with. And then we see any book errors, so anything that maybe we did that's just, human error that has caused a difference in our balances. So we're going to look at an example of a bank reconciliation. So the items that we're reconciling are listed here on the bank side. We have a deposit and an outstanding check, and then we've got book items, EFTs, interest revenue, bank service charge, and then an NSF check. So this is really what that bank reconciliation kind of looks like. And y'all, it really just takes like what the bank says we have versus what the book says we have, and we look at that and we make sure everything is correct. And yes, typically these do have to be done by hand, but usually it's also done in an electronic way so that we can make sure that everything is correct. And we always want the amounts to match. So you'll see here where it says these amounts must agree, they must match, they have to match. If they don't match, then we have an error somewhere and we need to go hunting for that. We need to go and find that error. So the bank balance and the book balance must always match. They must always match. So we just have to look for those differences. The beginning balance taken from the bank statement is $12,720, and then we have additions and subtractions, the deposits in transit. So these are this is a deposit on April 30th for $9,000 that has not yet been recorded by the bank. Sometimes this happens, especially right at the end of the month. And so we just have to add that to our bank balance because we know that it's there, it just isn't quite there yet. Outstanding checks, so check number 204 for $2,000 is outstanding. This amount is subtracted from the bank balance. So we wrote the check, but it hasn't been cashed yet by the person who we sent it to, so we need to subtract that from our bank balance. After all of those items affecting the bank balance have been adjusted, then we know what our actual bank balance should be. And then we look at our books and we see that the beginning cash balance taken from the general ledger is $20,850, and we've got to make some some changes to that. So we had electronic funds transfer for $100 that wasn't reported, so we need to do that. Interest revenue, so we earned some interest that we need to add, and then a service charge of $20 that we need to subtract. We also had another electronic funds transfer, so we paid $40, we need to subtract that, and then we had a non-sufficient funds check, so somebody wrote us a bad check, and we have to subtract that $1,200 from our balance. Once we do all of that, we want to make sure our two balances match, that our book balance matches our bank balance. So we will have to do some journal entries to make sure that those differences that we had to make are recorded and they are accurate. So we have our first one here on April 30th. So we had to debit our cash for $100 and credit our accounts receivable for $100. And this is to record the receivable collected by the bank. So we paid something for $100. So we have to record that. And then we have to debit our cash for $30 and credit our interest revenue for $30. This is to record interest that we earned on the bank balance. So we earned $30 in interest. And I misspoke, that first one is we earned $100, not that we paid it. And then the third one here is we had to pay a service charge. So we had to debit our bank expense or service charge expense and credit our cash for $20. Then we had to pay our utility bill that was taken directly out by EFT for $40. And then we also had to say, like, hey, you sent me a check, but it was bad, so now I have to re-increase my accounts receivable and reduce my cash for that bad check that was written for $1,200. When we journalize these, we can also look at different T accounts, and this kind of helps us to determine like what our actual balance should be here. So this is just an example of that T account. So our last objective here, so learning objective 7, we're going to use the cash ratio to evaluate a business's performance. So that cash ratio just helps us to determine the company's ability to meet its short-term obligations. So are we able to pay the bills that we have right now is basically what the cash ratio is telling us. So what this does is it takes our cash plus our cash equivalents and it divides it by our total current liability. So what do we owe within the next year? So our cash equivalents are highly liquid investments that can be converted to cash in 3 months or less. For example, accounts receivable. Here is an example for this from Kohl's, and it shows, we're going to look at 2 years here because it's always good to compare them. So our cash equivalents and total current liabilities from their balance sheet. So their cash and cash equivalents for 2016 was $707. For 2015, it was $1,407. And then the total current liabilities was $2,714. And for 2015, it was $2,859. So we're going to figure that cash ratio. So for 2015, we have 0.49, and for 2016, we have 0.26. So our cash ratio was obviously much better in 2015, and it was not so great in 2016. So what we would need to do is we would need to look at this and determine, okay, what happened? Like, why don't we have as much money or cash equivalents, and what can we do to maybe increase that cash ratio moving forward? And that's all I've got for chapter 8, y'all. Hope you enjoy.